Aloha, and welcome to the Sylvan Bell Business Growth and Exit Strategy Podcast, your guide to building companies that command maximum multiples. I'm Sylvan Bell, author of 5 books on business strategy and sales, creator of the Sell Framework, Scale Framework, and Driver Test. I work with owners of $10 million to $250 million companies, whether you're scaling for growth or positioning for a profitable exit. Each episode breaks down one framework, strategy, or concept you can apply this week to grow revenue systematically, scale operations, and maximize enterprise value. Let's get started. Welcome to episode number 44. What is an EBITDA multiple? How do buyers use it to value your business? Hey, it's your money. You should know how you're going to get paid. Nobody wants to talk about math until it comes down to profits. And how much money are you going to make? Now, EBITDA is French for profits in my world. And so you're going to hear this term a lot in this episode, EBITDA, EBIDTA. People pronounce it differently. It's like niche or niche. So if I'm saying it wrong, please forgive me. I said it the opposite way than what you like it. EBITDA is going to come up a lot, and it's earnings before interest, tax, depreciation, and amortizations. Now, every once in a while, my brain's going to click in and say deductions. If I screw up, change the word, just so you know. Right? For whatever reason, as I'm going through these notes, every once in a while, I may say depreciation, or I may say deductions. Simmer down if I make this mistake. Why do buyers use EBITDA instead of revenue to calculate what a business is worth? Here's what you need to know. Revenue tells a buyer how much money comes in. EBITDA tells them how much actually stays inside of the business. So you can have a business that's doing $10 million a year in revenue and have $1 million of EBITDA, or you can have a business that's doing $10 million a year and $3 million of EBITDA. Which one's better? Of course, it's the one with 3. It's easier to calculate. And it's easier for an investor to say, hey, this one is the least amount of risk. And the higher your profits inside of a business, the higher your chance of getting a better multiple or a bigger multiple from the private equity group, from the investor, or from the buyer. How do I calculate EBITDA multiple valuation for my business? Here's what you're going to do. You're going to start with your net income and then add back interest, taxes, depreciation, and amortization to get your EBITDA. Once you have that number, find the current trading multiple for your industry and multiply the two together. If you come up with $3 million and the multiple is 6, hey, you should be expecting somewhere around $18 million for your business. There might be ways for you to increase that number. If you're using a Titans thesis, it might be a little bit less depending upon how much risk is inside of the organization. What you actually receive at the closing depends upon how the enterprise value gets adjusted for debt, cash, and working capital at close. It's like if you just say, hey, Scott, I've got 3 million EBITDA and the multiple is 6, I'm going to get 18 million. Well, it's kind of the area that you should expect. It's more of the map instead of the destination. You're going to be close. You have the ability to adjust it. You could go up or you could go down, and depending upon how much risk is going to change the terms of the deal. What's a good EBITDA multiple for a mid-market business in the $10 to $50 million revenue range? For somebody who's going to be in that $10 to $50 million range, it's not uncommon to have a 5 to 9 times multiple, depending upon the industry and service. Sometimes it's going to be a little bit different. You may have a change of numbers. It could be 4 to 6. It could be 7 to 12. And one of the things that you're going to want to do is over time track this number in your industry or service. And the reason that you want to do this is you could time your exit. Sometimes a market is hot and people are willing to pay extra for a multiple, and then it fizzles out. And then that extra is gone. And then they're like, man, we're not really interested in that product or that service anymore. So we're not going to even go mid. So a product or service that could have been getting 12 at one point because everybody was excited about it could drop down to 6. This is why you really want to pay attention to what's going on in your market, in your product, and in your service, and track the multiple. How does the EBITDA multiple change depending upon the industry my business is in? Like every industry, service, product has a different risk profile. And buyers, what they're going to do is they're going to price that risk into a multiple that they're willing to pay. They have somebody with a digital spreadsheet or AI that's figuring out what the capital valuation of the business is. And the people who do this are good. This is what they do and this is what they live for. They get super stoked or excited about it. And you need to know that some industries pay more than others. And sometimes the industry is hotter in one part of the region or the area. If you have a platform company, this could work to your advantage. And a platform company means that you have the type of product or service that everybody wants. it's got a good reputation, it's got good reviews, and smaller or lesser known companies, products or services could be tucked in underneath what you have to offer. And then what happens is the private equity group, the investment group, or just the private investor, what they do is they start consolidating efforts. Like, okay, so we have one HR department instead of, all these small companies trying to do it on their own, or we have one fleet service management, or we have one legal counsel. And then they spread all that across all the other businesses and properties. And this is why you want to have a platform company. This is why you want to work from a Titan's thesis. And a Titan's thesis gives you the ability to come closer to the highest multiple that you can get. I can't promise that you're going to get it. You do want to put in some work. You do want to put in some effort to make some magic happen for your business. But, deals are ranked. An A+ deal means that you should get the multiple plus. An A deal means that you should get the top multiple. A B deal means you're going to probably be in the middle. C is going to be lower, and D is going to be half. You don't want to be graded a D, C, or B. You want to be somewhere between an A and an A+. A+ is your best bet and your best opportunity. What's the difference between an LTM EBITDA multiple and an NTM EBITDA multiple? LTM stands for last 12 months. Sometimes you're going to hear this referred to as a TTM, trailing 12 months. And it's a backwards look multiple based upon what your business has already produced. An NTM stands for next 12 months, or FTM, future 12 months. And it's a forward-looking multiple based upon projected earnings, which buyers use in a business that's growing quickly. So if the business is just ramping, going, and just doing everything that it can, there's got to be a way to project it. So they use the NTM. If your business is on a steep growth curve, negotiating on an NTM basis can significantly increase your deal price, but you're going to know that they might throw some terms in there and some holdbacks based upon what the possibilities are. And so I have seen deals where somebody goes to the buyer, to the market, and says, hey, listen, we're on a run. And the buyer says, well, I don't want to pay you on NTM or a future 12 months. We're going to pay you on trailing 12 months. And part of the negotiation can be, hey, if this company does better, I want to know from the upside because I put a ton of work and effort in. Can you get this all the time? No, but it may be worth asking if you've got a really solid business and it's doing really good. What's adjusted EBITDA and how is it different from reported EBITDA? All right, so reported EBITDA is what your financials show before any of the corrections are applied. Adjusted EBITDA is add backs, one-time expenses, owner perks, and above market compensation, non-reoccurring revenue costs that a new owner said, hey, we're not doing this. They're not going to carry it. The difference between the two of those numbers can be hundreds of thousands or even millions of dollars depending upon the size of the company, which is why you really want to spend some time in your books before you go to sell and normalize what those books look like so that you could prove hey, this add back belongs here. There's been times where I've looked at deals and I'm like, that add back doesn't go. The buyer's like, but it really should. And my answer is no, it doesn't go there. There are standard items that you can get in an add back. And then there's ones that are like, you're just trying to cram a bunch of money in this thing so that somebody's overlooking it and that they're not paying attention and you get more of a multiple. Now, I will share something with you. When investors see a whole bunch of add backs thrown in that shouldn't be there, it may be, and I'm not saying it is, it may be a sign that it's time to look at the other things inside of the business, inside of the financials, because if you've crammed a whole bunch of numbers in trying to get add backs, what else did you do, right? There's nothing wrong with asking hey, I would love to have this as an add back. It's a negotiation, but when there's tons of them, it could be a red flag the size of a building. How does a higher EBITDA multiple change the actual dollar amount I receive when I sell my business? So every full point is a year of profits. Remember, EBITDA is a French word for profits. It's a fancy word for profits. So if you're getting a 6 multiple, that's 6 years of profit. If you're getting a 7 multiple, that's 7 years of profit. And it's your business. You should do everything you can to get as much profit out of it. Now, this is where I like to have a super importante conversation with people and explain. Listen, if you're not willing to make the changes in your business, when somebody buys it, they're going to. You've had a problem with a manager or somebody, a supervisor, an employee. They'll put up with it for about the first 6 months. And then they're like, this isn't interesting anymore. Yawn. We're going to get rid of them. Oh, the initiatives that you didn't put in place, some of the standard operating procedures, some of the guidances, some of the decision bands. It's not a matter of if those things are going to happen. It's a matter of when. So you might as well put all the effort in and get paid for your effort and shoot for that maximum multiple by using a Titans thesis. And if you don't know, a Titans thesis is all of the effort that it's going to take to prove that your company is A+. An A in the market could get you, 6 to 10 multiple possibility, because I don't know your deal personally. A Titans thesis could get you 11, 12, 13. Like, if you can prove reoccurring revenue, you can prove some of this information, there is a possibility to get more. Can't say a definite, but there is a possibility you can get more with a Titans thesis. What EBITDA does private equity typically pay for a mid-market service business? Somewhere between 5 and 8 is normal for a service business in the mid-market. Sometimes platform business is going to be higher because they're going to tuck in some companies. PE buyers are disciplined, and they model their returns from day one. And their multiple offer is going to reflect what they need to hit to get their funding targets. They're taking their information that they got on your business, and they're going to a lender and saying, hey, listen, we looked at this company, and based upon our numbers, we really feel that they're going to have a 5 times multiple. And the lender is going to look at the numbers and go, hey, yeah, we agree. Now, the lender could be a private person. It could be a bank. It could be an institution. So there's just a lot of different ways that this goes. And sometimes in these deals, what happens is whoever's buying the company, if they're a smaller outfit, they may do a fundraise. And so some of the people may say, hey, show us a prospectus. What's going on? What kind of company is this? And what you want is the clean financials to get the higher payout. What you want is to have a Titans thesis so that when you're taking your company to the market, you can prove the history. If somebody looks at it, they're like, this is the history, and it's a good history. And the market typically pays 12, but we're going to pay 14 or 15, because remember, this is a negotiation. And the more proof and the more history that you have, and the better that your company runs, and the more profitable it has, the more profitability it is, the more profitable it is, the better your opportunity. How do I find out what EBITDA multiple my industry is currently trading at? Right? And an M&A advisor should be able to tell you this, because they have access to information. There's things like PitchBook, Capital IQ, GF Data, BVR. It shows industry multiples. And it gives you examples and says, hey, here's what's going on. It changes by the quarter. And what you don't want to do is rely on hearsay. I heard somebody got this huge giant multiple. Now, I will let you know, I've been around enough deals in my time that sometimes people modify that number to make it sound better than what they got. I have seen people at a bar brag about a deal saying they got a multiple that they didn't get. Just so you know. So be aware, you really want to go to a professional source to figure out what that multiple could or should be. What's an acquisition multiple of EBITDA, and how does it differ from a valuation multiple? A valuation multiple is what your business is worth on paper. That's what you're going to take a look at. An acquisition multiple is what you actually got paid in the transaction. Valuation multiples come from financial modeling, computer programs, acquisition models that come from real deals with real buyers, with real due diligence, and real negotiation. And what you need to know is when you're preparing to sell, acquisition multiples from comparable closed transactions are the only data that really matters. What are you going to get paid? I have seen deals start way high, and then somebody introduces an LOI smackdown. And if you don't know what an LOI smackdown is, sometimes companies, private equity, want to get you under letter of intent. Now, this doesn't happen all the time, but you need to be aware of it. But they're going to start really high. If your industry has a 12 multiple, they come in at a 14. And what they're could be doing, I'm not saying that they are, what they could be doing is just getting you under a letter of intent to see how your business operates and what you're up to. And the conversation that I would prefer to have from the very beginning and saying, hey, listen, if what you're planning on doing is just taking away a whole bunch of points here or EBITDA numbers for the multiple, and then you really have like a multiple of 7, we're not going to do that. Right? We're not interested. If you're coming to the table with a 14 and that number is probably not going to change, it might go down a little bit, but if it goes down significantly, that's an LOI smackdown. We don't want any part of it. And you need to know that sometimes, once again, not all the time, sometimes that happens. How does the EBITDA multiple change when interest rates go up or down? Okay, so somebody's borrowing money to make the investment, even if it's private equity. And so when you can get money at a lower interest rate, you're buying it cheaper. So it could increase the multiple for your business. And so sometimes what it comes down to is when you're planning on selling 5 years, 4 years, 3 years, 2 years out, and you're going to see that the administration changes in the United States. One side really likes to have tax advantages and one doesn't. And so sometimes, depending upon who gets voted into the presidents, the Congress, the Senate, may signal, hey, there may be some changes the way that tax code's going to be. And so it's an opportunity for someone to say, I'm going to look for a better multiple for an exit. I might wait or I might sell earlier. Timing of your exit is important. This is why I believe, 5, 4, 3, 2 years out, you're preparing. You're going to prepare the first 2 years and then time the market based upon 3. Can you sell immediately after 2 years? Yeah, you can. But what if the market isn't where you want it to be? What if you had a down quarter or a down semester before it was time for you to sell? It gives you the opportunity to get some rebound and get your trailing 12 months back up. And message from your sponsor, Scott Sylvan Bell. That's me. If you're getting value from this episode, here's how to go deeper. First, subscribe to my weekly newsletter, The Party, at scottsylvanbell.com. That's where I share the strategies, frameworks, and case studies I don't release anywhere else. You'll get one actionable insight every week you can implement inside your business immediately. Second, while you're on the site, download the complete Sell Framework, Scale Framework, and Drivers Test, all free with scoring guides, worksheets, and step-by-step implementation checklist. These are the same frameworks I use with $10 million to $250 million companies to build systematic revenue, scale operations, and maximize enterprise value. Go to scottsylvanbell.com right now, subscribe to the newsletter, grab the frameworks, and let's keep building companies that command maximum multiples. Let's get going. What is an EBITDA exit multiple and how do private equity firms use it to plan their returns? All right, so we're going to have to talk about how private equity works. So an EBITDA exit multiple is a multiple a private equity firm plans to sell your business at when they eventually exit their investment. Now, private equity tends to run on a 5 or a 7 year cycle. And so they have a thesis that they write. And they say, here's what we're going to do is we are going to go into a market and we are going to buy up a lot of product, services, companies, or practices. And then what they do is they combined the EBITDA and they get to a higher step. And then what they do is they sell it for more. So it's arbitrage. There is EBITDA arbitrage. So if somebody has a $1 million company and $300,000 in profit, they can expect a 1 to 2 times multiple. If somebody has a 3-year, $4 million company and they have $300,000 or $400,000 in profit, they might get a 2 or a 3 or a 4 times multiple. If somebody has got a $10 to a $50 million company, they may get 6 to 10 for a multiple. So if I can take a whole bunch of smaller companies and smash them together, like not physically, but I can take them and combine them together and get to a higher multiple to get that arbitrage, then what's going to happen is I got money loaned to me at a lower amount and I'm making money on the spread. And this is how private equity works. They go to the market, they look for inefficiencies, they find a way for the market to be efficient, and they make a run at it. I will share with you, recently there was a major heating and air conditioning conglomerate that did just this 7 years ago. They scooped up all the big heating and air conditioning companies on the West Coast, and they built one massive company, and they ran it for 7 years. And at 7 years, they went and sold it for billions of dollars to a major private equity firm. And that's how it works. You start with a bunch of small companies, stack them together, use the EBITDA for 5 or 7 years, get the return on your thesis, and then sell. And then everybody makes money, and then they do it again in a different product or a different service. How does owner dependency affect the EBITDA multiple a buyer is willing to pay? If you want the maximum multiple for your business, you want your owner dependency to go away. You want to have a chief operating officer or an operations manager or a general manager, whatever fancy term that you want to use, because what's going to happen is that knowledge needs to be transferred to who's going to run the company, because it shouldn't be you. And what you need to know is if you're not prepared and your ownership management team isn't prepared, then you're going to have to sit in the office and help make decisions based upon what you're allowed to do by your decision band. So what will happen is private equity buy the company, private investor buys a company, and they say, well, you haven't transferred enough knowledge, so you need to stick around for 3, 6, 12, 15, 18 months. And we'll pay you, but we need you to transfer the knowledge into the rest of the team. And that manager that you used to answer to you, you answer to him now. Like, that's freaking uncomfortable. So the higher the information's been transferred to the people that run the organization when you're not around, the easier it is for you to get a bigger multiple. The more that people rely on you to make decisions, you're probably going to get some of that multiple taken away. What's the relationship between reoccurring revenue and EBITDA multiple in a business sale? Right, reoccurring revenue is something that somebody can model. They can take and say, hey, okay, we know that on average, you're going to retain 90% of that money the first year. You're going to retain 80% of the money the second year. And you're going to retain 70%. Like, I'm giving you random numbers. Well, somebody can take that and get a loan based upon what the quality of that revenue is. And so having reoccurring revenue makes it valuable because on day one, when that company's bought, there's money coming in. They're not going after new contracts. The old contracts are helping pay for the business. And so what will happen is if you have 5 years, 4 years, 3 years, 2 years to prepare, you want things like monthly reoccurring revenue. You want to figure out a place that you can put some MRR inside of your business. You want to figure out a way that your contracts automatically renew. Because what's going to happen is somebody's going to come in and say, hey, I want to buy your company. Let's take a look at your reoccurring revenue. Oh, you don't have any? We're going to take some of your multiple points away. Oh, you've got a lot? We're going to shoot for the max multiple. And this is something that I talk about in the Titans thesis. How do EBITDA margins affect the multiple a strategic buyer will offer versus a financial buyer? Okay. A strategic buyer is more likely to offer to pay more because they have synergies. They have other departments inside of the organization that they're going to fold together. They may be able to put, the accounting all in one place. They may be able to put HR in one place. So instead of 7 companies having 7 HR teams, you got 7 companies have 1 HR team or 1 legal team. This is how they produce synergies inside of a business. And so it's a way to make the company more profitable. A financial buyer pays for the margins because they have no operational overlap to leverage. If your EBITDA margins are thin, a strategic buyer is often your best path. So if you're like, hey, which way? Do I go to a strategic buyer or a financial buyer? Well, if you've got thin margins, you go with a strategic buyer because they're going to be able to prove a better model with the synergies that they have already. What happens to my EBITDA multiple if my business has customer concentration risk? Okay, customer concentration is this. Really straightforward math. You have 10 clients and you do $10,000 a year in revenue. And one of those clients makes up 50%. So $5,000 of that revenue for the year comes from one person. And then the other $5,000 is spread between 9 people. So it's like $533 each. Well, what happens is somebody comes in and buys your company and you have 50% spread to one individual, one product, one service, then there's a huge risk if they leave. So what will happen is they say, hey, owner, we will give you the multiple that you're looking for, but if there's cancellations, we're going to make your holdout bigger. So let's say we were going to give you $10 million and you have customer concentration risk. Instead of giving you all $10 million up front, we're going to give you 60% of that or 70% of that. So you're going to get $7 million today and we're going to hold back $3 million. And if by chance that client cancels, we're just going to take it out of the $3 million. It really affects your multiple because if there's a lot of concentration risk, they just won't make a good offer. They'll give you like a C level deal or a B minus level deal versus that A plus Titan thesis deal where you got proof. In my belief, you really shouldn't have anything over 10 or 15% at most. And if you can reduce that, the better off you're going to be. And this is what happens in almost every transaction that I have ever seen. So you have somebody who's really good with spreadsheets. They're going to make a list of your top clients and they're going to score them. What's the potential of this person leaving? Do they have a signed contract or an agreement that's going to take place? Because when people hear that you sold, they're like, time to get out of a contract. We're going to go shop for a new provision. Oh, we can't. We're under contract. We've got another 2 years. We've got another year. So part of your seller's thesis or your Titan's thesis may be that you go out and you adjust your contract terms so that you know that people are going to be under contract and that you break that concentration down to 10 or 15% on your top client. How does a quality of earnings report affect the EBITDA multiple of buyers willing to pay? A quality of earnings report is an independent analysis that comes from a CPA or a CPA firm of whether your EBITDA is real, repeatable, and clean. Here's the thing. If the report confirms your numbers, it removes a major source of hesitation from the buyer because they can take that to a bank and prove it. There's a CPA that signed off on it and said, hey, here's what you need to know. This is a good deal. And they're at risk if they made a bad decision. If the report surfaces problems, you're going to find aggressive add backs, inconsistent revenue recognition, undisclosed liabilities, and it's negotiating leverage against you. So sometimes what will happen is a company that's in the mid-market will say, we're going to do a quality of earnings report every year. So we're going to do one for the next 5 years, 4 years, 3 years, 2 years before we sell, because it's history, right? In my belief, a Titan's thesis has history, and it has the ability to get you a higher multiple. Is it going to every time? I can't say that with certainty. That would be crazy. But it gives you the ability to go to the market and ask for more money. What's the difference between an EBITDA multiple and a revenue multiple, and when is each one used? EBITDA multiple is one of the most common because it's interest before interest, taxes, depreciation, and amortization. And it's the primary driver of value. Revenue is for high growth businesses where profitability has been suppressed in favor of growth, or they're in early stages and EBITDA is not meaningful. So if you're like, hey, Scott, spell this out. Okay, EBITDA, you did $3 million last year in profit, and the EBITDA multiple is 6, you're going to get 18 million. Revenue multiple is your company did $10 million and they gave you a 3 times multiple, you get paid 30. Is that how it plays out? It could. It just depends upon your product, service, and who's buying you. If somebody's coming in and say, hey, we want you for a platform company, sometimes what they'll do is they will give you a revenue multiple instead of an EBITDA multiple. You just got to be aware of how it works, and you got to ask the questions. So one of the things you could ask a seller is, okay, when you value my company, is it going to be based on EBITDA, or is it going to be based upon revenue? And they'll tell you, hey, here's what it is. How do I increase my EBITDA multiple before going to market? Okay, if you know that you're going to sell 5 years, 4 years, 3 years, 2 years out, there's 3 levers that'll help you move your multiple bigger than anything else. 1, you want to reduce owner dependency. You want your knowledge transferred to a chief operating officer, to a general manager, or to an ops manager, whatever you call them in your business. 2, you want to increase recurring revenue, whether that's monthly recurring or the way that you structure your contracts. And 3, you want to clean up your financials. You want to be able to have your financials ready. Somebody says, hey, I want to buy. Can you send your financials? Like, yeah. Can I send them to you right now? You want to have them up to date. Is maybe going a little bit overboard here, but you want to be able to say, yeah, I can get them to you in 72 hours. One of the biggest problems that a lot of companies face is they don't have clean financials, and it takes them too long to get to the deal. So what happens is an account executive may take and look and say, hey, we're going to pause this deal, and you might miss out on a multiple because they do change over time, because you weren't ready to go. So you do want clean financials, and you're going to want to have an X date, meaning that if it's January 1st, your books close on February 8th or 9th or 10th. And if it's February, at the end of February, your books close the beginning of March on the 8th, 9th, or 10th. And if it's the beginning of April, your books close on the 8th, 9th, or 10th for March. Like, if you put a cadence in place where you're consistently closing on time, and you're having somebody go through the books the way that it's supposed to be done, it makes it easier to find the right type of buyer. Why do EBITDA multiples vary so much between different buyers for the same business? Okay, let's just go through it. If you have a platform company that somebody's coming in your market or your area, and they want to buy a good name and a good brand with good reviews, they may give you more. If they already have a platform company, which I just explained, they may say, we're going to give you less. It's less of an opportunity. You may not be ready, but you want out. So you say, okay, I'm willing to take that deal. You may have somebody who already has synergies. And what the synergies are is they already have an HR team. They already have a law team. They already have a fleet division. And so it makes it easier for them to make the purchase. And it's a strategic buy. They can take that thesis and go get money for it in the market. And so this is why you want to have everything ready to go when it comes time for you to sell your business, that you can go for the offer that you want. You want to have your thesis. Who do you want to work with? What do you want to sell for? What do you think you should sell for? And this is the advantage of you having a Titan's thesis ready to go, because you could look at a deal and go, doesn't fit my criteria. I'm out. Done. Not going to do it. What's a typical EBITDA multiple for a service business under 10 million in revenue? Service businesses under 10 million in revenue typically trade in the 3 to 5 EBITDA range. And it just depends upon how much risk they are and how big their organization is. And if you've got a bunch of owner dependency, if you've got a bunch of diversified revenue, what you're going to find is the higher you get in revenue, the higher the chance you're going to get a bigger multiple if you can prove that profit. Size itself is something that's going to get a buyer excited, but if the profitability isn't there, it's not going to matter. So if you've got a $10 million company is doing $500,000 a year in profit, that's not very exciting. If you've got a $10 million a year company and is doing $4 million in profit, people are like, you got a 40% profit? Like, what is going on here? We got to talk. So profitability is going to make a big difference in all of this. How do I use EBITDA multiples from published sources to set a realistic expectation before talking to buyers? This is part of you building out your Titans thesis. You're going to research this pretty much every quarter. And you're going to look at places like GF Data, PitchBook, Axial, BVR, and you're going to use it as a starting point. You're going to use it as a range because it's not going to be exact. You're going to have things inside of your business that are amazing and fantastic if you're using a Titans thesis, but it's going to come across what's happening with your growth rate, your client concentration, your management depth, your industry subsector. You can use these published rates as a way to say, hey, here's my best guess of what's going on right now. And when you go into a conversation, you can ask and say, hey, listen, I looked and last month it said the multiple is 7. Why are you offering me 6? And they may say, hey, well, that's what we offer. Great, we're going to go find somebody who offers 7 or 8 or 9 or 10. You want to be prepared, and that's going to happen when you have a solid history. What's the single most important thing I could do to increase my EBITDA multiple before I go to market? You have to remove yourself from the revenue. You've got to take yourself out of the business. You've got to start transferring that knowledge, that data over to a chief operating officer, an ops manager, or a GM. Because what happens is, let's say that your clients are loyal to you. You've got to transfer those to somebody else. They got to go to a sales team. Because like at that point, the brand is you, not the company. They're going to price the dependency based upon you, and you might have to stick around longer, 3 months, 6 months, 12 months, a year and a half, 2 years, depending upon what's going on. You want to prove that the business can run and grow without you and retain clients without you. So things like standard operating procedures, things like organization charts with decision bands, job descriptions, all these things are pretty standard and pretty basic, but it's amazing how many companies don't have them. And so when you start taking a look and putting organization inside of your business, it's the thing that gives you the ability to propel and possibly get the maximum multiple. Mahalo for listening to the Sylvan Bell Business Growth and Exit Strategy podcast. Here's what's available to you right now. First, subscribe to this podcast so you get every framework we release. Second, visit scottsylvanbell.com to access the Sell Framework, Scale Framework, and Driver Test. All free with complete scoring guides and implementation worksheets. Third, subscribe to my weekly newsletter, The Party, where I break down strategies and frameworks you won't find anywhere else with one actionable insight every week. Go to scottsylvanbell.com and enter your email. And if this episode added value, share it with another business owner building a $10 million to $250 million company. Until next time, keep building companies that command maximum multiples. Aloha.